Welcome to this revision series on accounting standard. I hope that this revision series will help you to quickly build your concepts and cover all the accounting standards in detail. If you like these accounting standards revision, do let me know by liking the video, by sharing this video with your friends and commenting your feedback, and also do not forget to subscribe our channel. So let us start on with the revision. Let us start on with revision of accounting standard 13, accounting for investments. First we'll quickly cover up the concept covered in the standard, and then we'll move on to some very important practical questions, right? So let us start on with the revision. First of all, accounting for investment, let us understand what do we mean by investments. Investments have been defined as asset held for earning income. So the purpose of holding this asset is earning income, and you will earn income by way of dividend, by way of interest, and by way of rentals. When we say dividend, we refer to equity shares or preference shares. If we say interest, it could be some investment in bonds or debentures, etc. And rentals, maybe we have taken a property and we have given that property on rent. For capital appreciation, so the purpose of holding this asset is to have appreciation in the capital or the amount which you have invested on the asset. For example, if you buy equity shares of Reliance Industries for 1,000 rupees, the primary objective is that after a certain period of time, when the price increases maybe to 1,500, 1,800, we'll sell off those equity shares. Or maybe we have made investment into gold, investment into silver with the perspective of capital appreciation in future. And for other benefits to the investing enterprise, there could be a scenario that one enterprise wants control over the other enterprise for strategic reasons, and that is why this investment has been made. So investments are asset held for earning income by way of dividend, interest, and rentals, for capital appreciation, or for other benefits to the investing enterprise. Asset held as stock in trade will not be considered as investment. Now when we talk about classification of investment, the classification of investment would largely depend upon the nature of the investment, whether it's a short-term investment or it's a long-term investment, or it majorly depends upon the intention of the management, whether the management intends to hold it for a short period of time or the intention of the management is to hold it for a long period of time. So investment is largely classified into two categories. One is current investment, other is long-term investment. Current investments have been defined as that by nature they are readily realizable, so they are liquid. Whenever the enterprise wants to sell it, the enterprise can dispose of and realize the cash, and intended to be held for not more than 1 year. So the intention of the management at the time of acquisition of the investment is to hold it maximum for a period of 1 year. If we talk about long-term investments, they have been defined as investments which do not qualify as current investment will be treated as long-term investments. So maybe these are not readily realizable, or maybe they are held for a period of longer than a period of 1 year. Now we'll talk about the valuation norm. If we talk about current investment, current investments have to be valued at lower of cost or fair value. Fair value is generally the market value of the investment. So this again is on the basis of prudence and conservatism, where if we see that the market value of the investment is less than our cost, there is a probable loss which we may face in future, and therefore we'll recognize that loss upfront. So current investments have to be valued at lower of cost and fair value. And when you are comparing the cost and fair value, it is not that we have to compare the cost of all the investment in aggregate and fair value of all the investments in aggregate. We have to make this comparison on an investment and investment base. For example, I am holding shares of Reliance Industries, of Tisco, of Infosys. So I have to compare individually the cost and fair value of Reliance, individually the cost and fair value of Tisco, individually the cost and fair value of Infosys, and then arrive at the lower of the two. The comparison cannot be done on a totality basis. Any gain or loss on such comparison has to be taken to statement of profit and loss. Then we talk about the valuation norm for the long-term investment. Long-term investments are usually held for a long period of time, and it is believed that short-term fluctuation in the price of the investment does not impact the investment. Therefore, long-term investments are usually carried at cost. But if there is other than temporary decline, right? If there is other than temporary decline in the value of the investment, then we will reduce the investment to its fair value or the realizable value, and we will record that particular loss to the statement of profit and loss. So we normally say that if these investments are, there is an impairment or there is a loss of a permanent nature, right, other than temporary nature, then we need to make a provision for diminution in the value of investment. Usually these investments are carried at cost. Then we'll talk about cost of the investment. The cost of investment is the purchase price plus certain acquisition charges which are incurred while you are buying the investment. For example, if you are buying equity shares, we may have to pay certain brokerages, duties, etc. while acquiring it. So the cost of the investment is the purchase price plus the acquisition charges. Acquisition charges would normally be brokerage fees and duties. Now there could be a scenario that we are acquiring an investment, but the consideration for that acquisition is not paid in cash. The consideration may be paid by issuing other shares or securities, or the consideration may be paid by issuing some other asset. For example, I am buying shares of Reliance Industries, and for buying the shares of Reliance Industries, I am paying the person by let's say my investment or my holding in shares of Infosys. Or maybe there could be other way, I am buying shares of Reliance Industries, but I am paying the purchase consideration by transferring my land and building to the person who is selling me these shares. So let us look at this scenario. Investment acquired or partly acquired by issue of shares or securities. The acquisition cost of the investment will be the fair value of securities issued. So if I am buying the shares of Reliance Industries and in consideration I am giving the shares of Infosys, the acquisition cost of shares in Reliance Industries for me will be the fair value of the shares of Infosys which I have transferred. In exchange of another asset, look at the fair value of the asset which you have given up. Or you can also look at the fair value of the investment which you have acquired if the fair value of that investment is more clearly evident. Why is this? Because there could be a scenario, maybe I am giving up an asset, the fair value of that asset is not clearly evident, but generally it could be a scenario that the investment which I am acquiring, the fair value of that investment would be more clear. So therefore it says that if you are exchanging an asset and getting an investment, look at the fair value of the asset which you are giving up. You can also look at the fair value of the investment acquired if that fair value is more evident. Then we'll talk about treatment of interest, dividend and rental. We have seen that the main purpose of holding these investments is to earn income by way of dividend, interest and rental. So how do you deal with it? These are incomes, right? These are incomes and these have to be taken to the statement of profit and loss. But there is an exception. There could be an income which could represent recovery of past cost, right? This is a scenario in case of pre-acquisition dividend. When we get pre-acquisition dividend from a company in which we are holding equity shares, we normally treat that pre-acquisition dividend as a credit to our cost of investment, and we do not take this pre-acquisition dividend to the statement of profit and loss. We'll look at it with the help of an example. Let's say we purchase 1000 shares of Reliance Industries on 5th of June 2021. So the financial year is 21-22. Record date for dividend for 2021. See, this is our current year and this is the previous year, is 15 June 2021. So I have purchased shares on 5th of June. The record date for payment of dividend is 15th of June, right? And this dividend is obviously for the previous year. I received this dividend on 28th of June 2020, right? This will be treated as pre-acquisition dividend because dividend is from the profits of financial year 2021, but I became a shareholder in the financial year 21-22. By virtue of holding these shares on the record date, I have received this dividend. This will be treated as pre-acquisition dividend, and this division should be credited to the cost of the investment, right? So we will basically reduce the cost of the investment to the extent of the dividend which I have received. Now we'll talk about the right shares. See, right shares, we know that any further issue of shares have to be first offered to the existing shareholders of the company, right? So when the company comes up with right issue of shares, the company will give the existing shareholder an opportunity or an option to subscribe to the new shares. The shareholder, right, at its discretion has a right either to buy these shares, or the shareholders may also share his right entitlement in the market. So it says when right shares are offered, the shareholder can buy or subscribe to the right shares. So if I am buying or subscribing to the right shares, I am originally holding the shares of the company. By virtue of this existing holding, the company is giving me right shares. So when I am buying these right shares, the cost of these right shares will be added to the cost of my original holding. The cost of this right share is added to the carrying value of the existing investment. The other option, if I don't want to buy the right shares, then the other option is to renounce the right entitlement. Right? I will sell these right entitlement to somebody else who may be willing to buy the right shares of the company, and the sales proceeds of these right entitlement is normally taken to the statement of profit and loss. But there is an exception. If this investment is acquired on cum right basis and immediately after the investment becomes X right and the X right price is lower than the cost of acquisition, then in that case the renunciation proceeds should go ahead and reduce the cost of my investment to its market price. Interesting scenario. We'll have a look at it with the help of an example. Let's say Reliance Industries Limited announced right issue of 1 share for every 2 share held on 1st of June 2020, and the price at which it is offering shares to the existing shareholder is 1800 per share. The record date for right issue is 8th June 2020. This means that whosoever is holding these shares of Reliance Industries Limited on 8th of June 2020 will be eligible to get the right shares, and the right shares will be offered as 1 share for every 2 shares held. Based on this, we purchased 1000 equity shares of Reliance Industries on 7th June 2020. See, the price or the market price which will be prevailing in the market between 1st June 2020 and 8th June 2020 will be known as the cum right price. Why it will be known as cum right price? Because more people will be interested in buying these shares. The demand for the shares of Reliance Industries Limited will be high during this period, because by virtue of buying these shares in this period and holding it till the record date, which is 8th of June, right, the holder of the share will be entitled to get right shares, and normally right shares are issued to the existing shareholders at a discount to the market price. So since the demand for the shares will be more, the price of the Reliance shares will increase and they will trade at a premium, and this price will be treated as cum right price. So we have acquired 1000 shares of Reliance on 7/6/2020, which is between the announcement date and the record date. So the price at which we are buying it is known as a cum right price. So we bought it at 1900 per share. To be eligible to get the right shares, subsequently we purchase 80% of the right entitled to us, and the balance right entitlement was sold at the rate, you can write, let's say 70 per share. So 80% of right shares we purchased and 20% of the entitlement we sold to somebody else who wanted to buy these shares. Now we'll see how to deal with it. Number of right entitlement, we had 1000 shares. For every 2 share we'll get 1 share, therefore 500 right entitlements I will get. We purchased 80%, right, therefore 500 entitlement into 80% into 1800, which is the price at which the right shares are offered. So 7,20,000. Our entry will be investment in equity shares of Reliance Industries to bank. So we have purchased this share and we accumulated the cost in the investment ledger. Sold the right entitlement. So out of 500, 20% has been sold and we are selling it at the price of 70. So we have received rupees 7,000 by selling these right entitlement. Now what we need to see, that since we have purchased in the cum right period, had it been that we are holding these shares even before the right issue was announced, we don't need to do this treatment, right? Directly the renunciation proceeds will go to the statement of profit and loss. This treatment we have to do only because we have purchased the shares in the cum right period. We have purchased it at a cum right price. So we need to be careful. We need to look at it that once this share becomes X right, means on 9th of June when the price opens in the share market, we'll have to have a look at that price. So the X right price on 9th June, right, 2020, in case 1 it is 1950, in case 2 it is 1895. Please do it as 1895. In case 3, it is 1880. So in case 1, we can see that the X right price after the record date of right issue is 1950. is greater than the come right price of 1900 at which we had purchased these shares. Therefore, entire thing is to be taken to PL, because this treatment of crediting to the cost of the investment will come only when the come right price is greater than the X right price. Here the X right price is greater than the price at which we purchase. So we don't need to do any additional treatment. In the second case, the X right price after the record date is 1895. It is less than the come right price at which we had purchased the shares of 1900. So the notional loss. Why notional loss? Because we haven't sold this off as yet. In future the price may increase. This is just to take a decision on the fact that whether we take the entire renunciation proceeds to the PL or the renunciation proceeds should be credited to the cost of the investment. So in this case, our notional loss is 5,000, 1,000 shares we had purchased. We had purchased at 1900. Now the X right price is 1895. There's a notional loss of 5,000. So we'll say bank account debit, because total we have received 7,000 by selling the rights, right? Investment we will credit by 5,000 to the extent of notional loss, and balance 2,000 will be credited to the statement of profit and loss. In the third case, the X right price is 1880, which is obviously less than our come right price of 1900 at which we had purchased the shares of Reliance to get entitled to buy the right shares. So here the loss is 20,000. The notional loss is 20,000. In this case, entire renunciation proceeds will be credited to the cost of the investment. Please remember that this treatment will come only when the shares were purchased during the come right period, and immediately after the record date of the right issue, the X right price is lower than the come right price at which we had purchased the shares, right? Otherwise, always the renunciation proceeds will go to the statement of profit and loss. Then we'll talk about disposal of investment. Disposal of investment is basically the difference between the net sales proceeds of the investment less the carrying amount of the investments in our book, and this carrying amount will be calculated on the basis of average method. The difference, profit and loss, will be taken to the statement of profit and loss. Then we'll talk about reclassification of investment. We have seen that we classify investment as current and as long term. Current investments are valued at cost or fair value, whichever is lower. Long-term investments are usually carried at cost, but if there is other than temporary decline in the value of the investment, then we recognize a provision for diminution to bring it down to its fair value. So if we are classifying, means earlier we had classified the investment, when we acquired that investment we classified it as long term. Now we have changed our intention of holding it, and now we want to classify as current. Or it could be vice versa, that initially when we acquired the investment we classified it as current investment, and afterwards we are changing our intention, we want to hold it for a long period of time, and we are classifying it to long term investment. Please remember, when we are reclassifying from long term to current, the rule for long term is that it should be carried at cost, but if there is other than temporary diminution, then we need to recognize a provision and the value of that investment will reduce. So the transfer will be made at lower of cost or carrying amount. Carrying amount might be lower if we have recognized a provision, only if there is other than temporary decline in the value. So this reclassification will be done at cost or carrying amount, whichever is lower at the date of transfer. If we are transferring current investment to a long-term investment, the rule for valuation of current investment is cost of fair value, whichever is lower. Same treatment will prevail. The transfer will be made at lower of cost or fair value, whichever is lower on the date of the transfer. Then we'll also talk about investment property. See, normally when we talk about land and building, we straight away think about PPE AS 10. AS 10 says that PPE is an asset which is held for use in the business, and it is intended to be held for a period of more than 12 months. But investment property is an investment in land and building not intended to be occupied substantially for use, by or in the operations of the investing enterprise. So the intention of holding a land and building as a PPE is using it in the business. Here we are holding land and building, but the intention is not to use it in our business, but to hold it for maybe capital appreciation purpose or maybe for earning rental purpose. Therefore, it is to be treated as investment property. So what is an investment property? It is an investment in land and building which is not intended to be occupied substantially for use by or in the operations of the enterprise. How do you deal with this investment property? It says that you deal it with the cost model which you have learned in accounting standard 10, property, plant and equipment. Then we'll talk about certain disclosures which we need to make. We need to disclose the accounting policy for determining the carrying amounts. If it's a current investment, cost of fair value, whichever is lower. If it's a long-term investment, usually carried at cost. And if there is a reduction because of other than temporary decline in the investment, we'll record a provision. Then we'll have to show how much of interest, dividend, rentals we have recorded in PL. If there's a disposal of investment, what is the profit and loss on disposal? If there is a change in the carrying amount of investment, we need to disclose in the PL. If there are certain significant restrictions on the right of ownership, liability of the investment, remittance of the sales proceeds or the income related to the investment, we need to disclose it in the notes to account. We need to state the total amount of quoted and unquoted investment. Quoted investments means those investments the price of which is available in the stock exchange is quoted investment. Unquoted investments are usually those investments which are not listed on any recognized stock exchange. And if we are holding quoted investment, we need to tell the total market value. We need to also disclose the total market value of our quoted investments, and whatever other disclosures are required by Schedule 3 of the Companies Act, that also needs to be dealt with. So now we are done with the concept portion of the standard. We'll start with the practical exercise. Let's come to question number 1. It says an unquoted long-term investment is carried in the books at cost of rupees 2 lakh. The published accounts of the unlisted company which are received by us on May 2017 showed that the company was incurring cash losses with decline in market share, and the long-term investment may not fetch more than 20,000. So our normal rule is that long-term investment should be carried at cost. But if there is other than temporary decline in the value of the investment, we will have to provide for that loss. So here the company is incurring cash losses, right? The market share is reducing. So it could be an indicator of the fact that there is other than temporary decline in the value of the investment, and we may need to let's say recognize a provision for diminution in the investment to the extent of 1,80,000, which is the difference between 2 lakh and 20,000. We bought it for 2 lakh, our cost is 2 lakh. But currently if we go and sell this investment, it may not sell for more than 20,000. So there is an impairment or there is a loss to the extent, or a probable loss to the extent of 1,80,000. How will you deal with this in preparation of financial statement of R Limited for the year ended 2017? So we'll have to provide for this loss. So whenever we write an answer for accounting standard, first we'll quote the relevant paras from the accounting standard, then we'll say our analysis of the case, and finally the conclusion paragraph, right? So I'll read it for you. As per accounting standard 13, right? Long-term investments are usually carried at cost. However, where there is a decline other than temporary in the value of the long-term investment, the carrying amount is reduced to recognize the decline. Such reduction in carrying amount is charged to the statement of profit and loss. Then the standard says that the indicator of other than long-term decline in the value of investment can be obtained with respect to market value of the investments, the performance or the results, the asset, the expected cash flows from the investment, right? So we are saying in the given case, R Limited holds an unquoted long-term investments which is carried in the books at cost. The published account of the unlisted company shows that the company is incurring cash losses with decline in market share, and the long-term investment may not fetch more than 20,000. The fact that the company is incurring cash losses and there is a reduction in the market share is an indicator of other than temporary, right? It's an indicator of other than temporary decline in the value of the investment. In this situation, the company should recognize a diminution in the value of the investment to the tune of 1,80,000 and the reduction in the carrying amount of and reduce the carrying amount of the investment to 20,000. The reduction of 1,80,000 should be charged to the statement of profit and loss. Clear? Next, question number 2. X Limited on 1st of January 17 had made an investment of 600 lakh in equity shares of Y Limited, of which 50% is made under long-term category and rest under temporary investment, means these are treated as current investment. The realizable value of all such investments on 31st March became 200 lakh as Y Limited lost a case of copyright. From the given market condition, it appears that reduction in the value is not temporary. So it is a reduction which is of an other than temporary nature. How will you recognize the reduction in the financial statement for 31st March 17? So here what is happening, total investments which have been made is 600 lakh, 50% is current and 50% is long current. So 300 is current and 300 is long term. Now, the rule for current investments is cost of fair value whichever is lower. So for current investment, the cost is 300 lakh. Total investment is 200, of which 100 lakh will be under current category and 100 will be under long term category. So 300 and 100, therefore 100 is the value at which the current portion of the investment will be carried on. Long term investment, we know that it is usually carried at cost, but here we can see that the decline is of other than temporary nature, so the long term portion should also be reduced, right? Reduce, and a diminution in the value of investment should be recognized. So total value of the investment at which it will appear in the balance sheet will be 200 lakh, 100 lakh will be in the current category and the another 100 lakh will be under the long term category. So you can read through this, everything has been explained. We'll go to question number 3. Measures Innovative Garment Manufacturing Company Limited invested in shares of another company on 1st October 16 at a cost of 2,50,000. It also earlier purchased gold for 4 lakh and silver for 2 lakh on March 14. The market value of all these on 31st March 17, which is the current period, right, is shares 225. We purchased it for 250 in October 16 and in 17 it is 225. So there is a reduction. For gold 4 lakh it has become 6 lakh, silver 2 lakh it has become 3 lakh 50. So other two investments there is no worry because the fair value is greater. For shares the value has reduced. We purchased it in October 16 and we are 31st March 17, a 6 month of holding. Let's see whether they have told about their intention of holding it for what period. How above investment should be shown in the books of Measures Innovative for the year ended 31st March 17 as per the provision of accounting standard 13. So what we could say is that for shares they haven't told us whether they intend to hold it for a period of up to 1 year or more than that. So we may say that if this investment is to be treated as current investment in shares, then we'll apply the rule cost of fair value whichever is lower, and it should be valued at 2,25,000 and 25,000 of loss should be recorded in the statement of profit and loss. But if we are considering this investment in shares as a long-term investments and there is no indicator or there is no fact stated that this is other than temporary decline, so this shares investment in shares will continue to be carried at 2,50,000 in the financial statement. Gold and silver have been purchased in 2014 and now we are in 2017, so it is apparent that the investment in gold and silver is for a long-term basis, and also there is no decline in the value of that investment, so these should be carried at cost. So we have stated, we have drafted the answer. You can read through the answer. We have discussed the facts. Let's go to question number 4. ABC Limited wants to reclassify its investment, right? So it is reclassification. We have already discussed from long term to current, cost or carrying amount, whichever is lower on the date of the transfer. From current to long term. For current, we will say see cost or fair value, whichever is lower at the date of transfer. So ABC Limited wants to reclassify its investment in accordance with AS 13, decide and state the amount of transfer based on the information. A portion of current investment purchased for 20 lakh to be reclassified as long-term investment as the company decides to retain them. The fair value of the market value on the balance sheet date is 25. So the cost is 20, fair value is 25. Our rule is cost of fair value, whichever is lower. So the reclassification has to be made at 20 lakhs. Clear about this? We'll compare the cost and fair value, whichever is lower will be the value at which the transfer shall be made. Another provision for current investments purchased. Another portion of current investment purchased for 15 lakh is to be reclassified as long term. The market value of these investments is only 6.5 lakh. So cost or fair value, whichever is lower. So in this case, reclass has to be made at 6.5 lakh because the fair value is lower. In the third case, certain long-term investments no longer considered for holding purpose to be reclassified as current. So long-term to current, so it will be cost or carrying amount, whichever is lower. The original cost is 18 lakh, but had been written down to 12 lakhs. So it might be there was some other than temporary decline in the value of the investment, and they have bought this investment down to 12 lakh, right? To recognize other than temporary decline. So here the cost is 18, the carrying amount in the books is 12, so cost or carrying amount, whichever is lower. So here the reclass has to be made at 12 lakh, right? So we have drafted it. In the first case, we have said that the transfer should be made at 20 lakh. In the second case, we have said that the transfer should be made at 6.5 lakh. And in the third case, we have said that the transfer should be made at 12 lakh based on lower of the two comparable amounts. Right? So by this we are done with the revision of Accounting Standard 13. Do let me know how you liked it. Leave your feedback in the comment. Do like and share the video, and please do not forget to subscribe our channel and also share with your friends. Thank you so much and all the best.